gold took off. Okay. So silver rallied as well, but was sold off against gold because maybe it's not going to be, maybe it's going to be a recession. Maybe he's not, but maybe he's not going to cut. Gold is still in a range. It's still in a range. Okay. But one of the systems that I look at says, and I said this in the conversation on Sunday, above 33.47, the gold market should go to 33.90 in short order. And above 33.90, 34.24. Now, I'm not predicting those, but I do have a position on starting last night as a result of that. So we're looking good. Silver is a much simpler story. It held the 50-day moving average. It withstood another sell-off. It had nothing to do with silver. It was on the back of copper. That was a dip to buy. Now, I didn't say it then. I'm already long. But Michael Oliver hinted at it. He's actually called for $60 or $70 from his mouth to God's ears. I hope he's right.
Due to geopolitical tensions, inflation concerns, and safe haven demand, gold recently surged and broke higher as market momentum resumed. In the meantime, silver also rallied, although it performed worse than gold. Uncertainty regarding recession risks and mixed views about the Federal Reserve's next rate move are probably the causes of this discrepancy. The price of gold on July 28th, ahead of the Fed's two-day meeting, is $3,332.46 per ounce, and it's likely to remain around that price by the week's end, too. That's because a rate cut is highly unlikely to be issued this week. Initially, the market focus centered on gold's traditional status as a haven during economic uncertainty. However, attention has rapidly shifted to silver's unique position at the intersection of monetary and industrial demand. The speaker, Vince Lanci, a seasoned commodities trader and market strategist, outlines that gold prices climbed steadily after July's U.S. jobs report revealed only 73,000 new positions, far below expectations, accompanied by downward revisions of jobs for May and June. This sparked intense speculation about a Federal Reserve rate cut in September, with markets giving it a higher probability. As a result, spot gold jumped roughly 1 to 2%, testing levels from its highest since late July. Citi raised its three-month forecast to 3,500, citing persistent tariff inflation, a weakening dollar, and slipping U.S. growth expectations. Gold ETF inflows are surging globally. North American inflows reached $21 billion, while Asia posted an all-time high of $11 billion in allocation, signaling broad institutional demand. Silver also rose, up around to roughly $37.35 to $37.40, extending Friday's gains. However, silver's momentum was tempered because of weakness in copper, which fell sharply in response to tariff uncertainty, undermining silver's industrial-linked pricing. Market veterans point to silver's tight structural fundamentals, including a prolonged supply deficit and strong industrial demand, as sustaining its bullish case despite near-term sector drag. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
The fact that he switched that quickly, which means gold works in the dollar weakness coming. And clearly, if you look at the dollar today, gold doesn't care about the dollar weakness because it's not weak. Serbia repatriating all of its gold reserves, abandoning Western vaults. Some people have actually asked me why that's relevant, or why would they do that, considering that they're in a country that could be invaded, in the middle of Europe. And the answer is they view the risk of confiscation bigger than the risk of invasion. Think about that. And by the way, historically, Serbia and Russia are pals, historically. If you go back to World War I, you can see that. Dear Zoltan, isn't BW3 really China-style BW2? Yeah, I mean, Bretton Woods 3, the concepts that Pozar talked about were valid. But when I look at what China is doing, and you look at the history of what China does, they take an idea that's worked, they move some pieces around in it, they make it more efficient, and they maximize it. They scale it. So Bretton Woods 3 is really just China using the dollar architecture, the dollar model. You can read that. Moving on. Coming soon, Martin Armstrong has been on his horse about essentially 100%. He has a model, and the model says 100% chance of war. And I hope he's wrong, but he's said it more than once in this time frame. So it wasn't a passing comment for him. And every day that goes by, we kind of get closer to these problems where Trump is kind of painted into a corner. Either he's been painted into a corner or he's painted himself. The trade deals that are being announced look good, but I don't think they're going to be honored. Putin is defying him. He's He's actually doing a little brinksmanship with the nuclear subs. I don't know what that's going to do, but uh, empirically, we should be moving the clock closer to midnight. Mexican silver, we have a history of that written by someone else. Really good piece. We liked it, and we'll share it with you. And we also are going to take a look at an older piece called Gold and Silver Shorts, Were the Real Demise for Bear Stearns by Doug Casey. Light week for data. Let's do a final market check. Let's go through what happened on Friday. All right. Well, here we go. There's gold daily. I went through all of this in more detail in the Sunday conversation, but it's easy to say you're bullish after a market rallies. A lot of people do that. Last week's behavior in the gold market, Friday aside, was classic fund liquidation. Down, open interest dropping, down, open interest dropping, down, open interest dropping, normal stuff. And I said, okay, we're still in a range again. And then we got to the 100-day moving average, and it held again. So someone bought it. We don't know who. The sheer power that it was propelled off of this area when the jobs number came out was really eye-opening to me. Kind of what Martin Armstrong is saying when you think about it. The jobs data came out very weak. The stock market had already been on the lows for the day. It bounced a little bit because weak jobs numbers mean, oh, the Fed can ease, and then it sold off again, and gold took off. So I believe the market is collectively doing the following. The result was the market is now expecting the Fed to cut at least twice. Now, they'll change their mind from time to time. We know that. But if you're a person who's got gold on your radar, and the macro discretionary boys have gold on their radar, and you see the solutions to the problem as either cutting or not cutting for Powell, and you see unemployment low, employment dropping, and inflation sticky, there are only two things that can come from that. One is stagflation, where Powell can't cut because unemployment, even though it's low, inflation is too high. That's stagflation. And during stagflation, nothing beats gold. Two, recession. And recession means he's got to cut rates, and that means gold goes up. I believe that we're economically at a point where Powell is damned if he does and damned if he doesn't. The unemployment number, the weak unemployment number, was the most important thing in a long time. With the revisions, made it even worse. It's almost like Trump wanted that, so Powell would have to cut. And people are talking about emergency cut as well, too. I don't know if that's going to happen. I don't see what the emergency is, at least not on the data.
In the second quarter of 2025, over 80% of large U.S. companies beat both earnings and revenue expectations, an unusually strong showing. The hiring trend for U.S. manufacturers remains fairly steady, despite the whiplash caused by President Trump's trade war. There is no sign of a boom from a shift to domestic manufacturing, but there is no sign of a bust as U.S. firms face higher tariffs on key inputs. At the Fed policy meeting that concluded on Wednesday, Governors Christopher Waller and Michelle Bowman dissented from the decision to leave rates unchanged, believing that a rate cut was justified. It looks like they had a point. In response to a question from Neil earlier this week, Federal Reserve Chair Jerome Powell said that the unemployment rate might be a more reliable indicator of the labor market's health. The main number you have to look at now is the unemployment rate, Powell said on Wednesday, and added that demand for workers has slowed, but so has the number of workers the economy needs to add to keep the unemployment rate steady. With AI accelerating this trend, job losses during a downturn could be more profound and prolonged. Even in a growing economy, firms may continue to cut jobs to stay competitive, as automation reduces the need for rehiring. Now, let's recall the interview.
In the second quarter of 2025, more than 80% of large American firms beat their earnings targets. Nearly 80% also beat revenue expectations. These are extremely high marks compared to the last 10 years, which were peaking at 77, 75, 71. Okay, this is big because usually when those numbers peaked, employment would get tighter. People were getting hired. The second is from the labor market itself. Job growth came in weaker than expected. As I said, earlier months were revised lower and unemployment was higher. The workforce shrank. Together, these numbers tell a simple story. Profits are rising, jobs are not. Companies, especially in the tech sector, are becoming more productive while employing fewer people. So what comes next? If the economy worsens, job losses will grow, of course, right? That is what usually happens to begin with. But with AI in the mix, job losses could happen faster and hit harder. The recovery that comes after a recession may not bring those jobs back. Machines do not need to be rehired, and they don't have pensions. Even if the economy stays flat or grows, let's assume that GDP, which is a prediction of earnings, and earnings have been falling through, remains strong. GDP and earnings will grow, jobs will still be cut. Okay, firms won't cut as aggressively because they can look away from cost cutting because their bottom lines are growing because their top lines are growing, right? Their sales are growing, and so they can ignore the fat, which is the extra workers. But smarter, bigger, more flexible types of firms will adopt even in a growth environment. Other firms will follow Darwinistically. If they do not, they will fall behind.
Gold's attraction as a haven was further reinforced when it rose in response to disappointing U.S. job statistics, growing concerns about inflation, and escalating geopolitical tensions. According to Vince Lanci, expectations of a Fed rate decrease were heightened by the July jobs report, which showed only 73,000 new jobs, helping gold reach late July highs. Institutions are investing heavily in gold exchange-traded funds, ETFs. Citi projects a 3-month objective of 3,500. In the meantime, despite positive long-term fundamentals, silver also saw a surge but was restrained by declining copper prices. With Powell recognizing unemployment as the primary indicator, the labor market is deteriorating, even as corporate earnings remain high. Because automation is displacing humans even during periods of economic boom, AI is accelerating structural changes and reducing the likelihood of job recoveries after recessions. What potential effects might inflows into institutional gold ETFs have on market sentiment in the upcoming months? How may future Fed policy change if job losses increase despite economic expansion, given Powell's emphasis on unemployment as a crucial indicator? We would love to hear your thoughts, so please share them in the comments box below. If you found this video helpful, please give it a thumbs up and remember to subscribe for future videos. Thank you for joining us on this adventure.